Make sure we're looking at the same thing.
Please do. I'm so so maybe because it is like a huge ass difference. God, I'm still trying to find that one thing because I think they merged it because a guy was in GPM, the fund that merged in, like held 15% of the stock, and I think they wanted to keep him for like the MER or something like that.
I just find what's a pain in the butt about this is there's no links. There we go. Okay, let's see if this makes more sense. Let's see. Okay, total distributable earnings, 11. Okay, and let's see. This is page 66. And this was the report as of May 31st, 2021.
Yeah, that was their annual report. So they're actually 2 months late then.
Yeah, hold on a second.
Yikes.
Did they release a statement about why they were late?
No, I've called them, and the response I got from the guy was because of the fund merger, they have way more funds to keep track of, so it's going to take them longer than usual. Wait till the end of June. I did. And then when I called them back, a different person answered, said, oh, it's going to come out end of July. So they keep delaying it, and I don't know why, and it's starting to scare me a bit.
Okay, so let's see, May 31st. So it looks like they had, so the loss basically wiped out all of their retained earnings. So here's kind of how it works in accounting. So like I said, this total distributable earnings is affected by dividends and it's affected by profits. So basically, whenever you make a profit, the amount of the profit increases this.
Mm-hmm.
Whenever you pay a dividend, and like an actual dividend, it comes from this. So we see here in May 31st, it has 11, I'll just call it 11 million. I don't know if it's like thousands or what. So they go from 11 million to negative 50 million. So they must have had a huge freaking loss in this most recent statement, which we saw.
Yeah, which was mostly
caused by options writing and unrealized losses in unaffiliated issuers. So that's my two concerns. You see the massive loss on options and then an unrealized loss. That means they didn't actually sell these securities or whatever they're issued in. They lost $26 million. So we look at the prior year. I wonder if they had like a positive income from that. Yeah, okay, look what happened. So this is the prior report, right?
Yeah.
Investments in unaffiliated issuers. It looks like all the stocks or stonks that they invested in went up massively. And they wrote them up. And then it looks like this whole market crash or whatever's happening, they had a little bit of losses. So when you're looking down here, so like just starting from the top of this income statement. So in the top, they have, their interest from their dividends and interest and dividends, and then they subtract all their fees. And then you have their net investment income. So they invest in securities, stocks, bonds, and they generate income from that. And then they also have to track the prices of these securities. So the total return, they're basically showing you the total return here. The total return consists of, interest and dividend income plus price fluctuations in their underlying securities. So in their most recent quarter, they had positive net investment income, 26 million, I'll call it that. But a lot of their investments that they invested in went down in price. So that's why they had a unrealized loss. So we go back, let's see.
Is for financial statements, you actually keep track of the unrealized gain and losses, or no? Because does it matter if you haven't sold or took the loss on it?
Well, okay, let's say you buy Voyager and it goes down 99%. Do you care?
Oh yeah, of course.
Yeah. I mean, it's like
I mean, like that makes sense, but like financially, like if excluding that, when they have then ended the year positive. Like for paying the dividend, they would have ended the year positive then.
If you're just looking at net investment income, yes, they did. But it's all about total return. The total return. So the year prior, they had, let's see, net change, net realized and unrealized gain, net increase in assets. So that quarter prior, or that year in prior, they had a great year. They made 157 million or billion or whatever that is. And then you go look at this, let's see, net increase in net assets resulting from operations.
Barely anything.
Barely any. So it looks like they actually did have a total, profit, but that was a massive decline.
Mm-hmm.
And that was mostly attributable to, them losing money on options and their underlying stocks or whatever they invested in taking a huge hit because the market's down. So, I mean, this could be a temporary thing, to be honest. I can't predict the future, but most stocks are down. Mm-hmm. Most people are in the red.
Yeah.
So, let's see. How much is their income declined? So they had net investment income of 43 million, and the quarter after they had 26. And this is but this is annual. So if you annualize this, because they made 43 million here over a year.
Yeah. So they're already halfway there.
Yeah. So honestly, it's not looking that bad when it comes to the net investment income. That's why you got to be careful with the statements, because sometimes the statements will say, oh, it's 6 months. And then this one is a whole freaking year.
Yeah.
So if they stay on track, it looks like their net investment income, if nothing changes, you double it, they'll have 52 million in net investment income.
Mm.
If everything stays the same. The question is, what's going to happen with all these underlying investments?
Yeah, especially if most of it, again, because they just updated it being, it's a bond fund mostly, so you expect it, but, it's like, what, 60% bonds at this point?
Yeah. So,
65.
Looking at this thing, it's got a big part of the dividend is return of capital. That's just giving you your money back, basically.
Mm-hmm.
It's got an insanely high expense ratio relative to an index fund. It's extremely complex. Look at this. Options, futures, swaps. There's a lot going on here. So you always have to ask yourself, do I really understand? And even if somebody explains it to you, I don't know what they're doing. There's no way I can tell. I can look at the financials and say, oh, I can see they have these investments and they have this much income, but I don't know what the management's doing right now. It's been what? How many months since this? It's been 8 months.
8 months, yeah. 8, 7.
So I would definitely look at that new report that comes out and see what the trends are.
Is the turnover rate something to be worried about? Because I went from I hope they show a turnover rate. I don't think they do.
Turnover factors into taxes, because turnover just means they're what percentage of the fund they're trading out every year.
Okay, so realistically for investors, it means nothing.
It does in a taxable account.
But since it's in my TFSA, it doesn't.
Yeah, if it works the same way in the United States, it's not such a bigger deal. It's not a big deal. But if you had this on Robinhood or something,
you get decimated.
Because you have an expense ratio that's almost 2%, which that's a lot. That's very high. And then you have high turnover. That means it's tax inefficient. This is an income-oriented fund. So as it's paying interest and dividends, at least in the United States, with a real estate investment trust or whatever, or if they're paid out to you, you're going to pay taxes on them.
Yeah.
So that's another fee that you're paying. You're just getting butchered, really, when it comes to fees and taxes, if this is outside a taxable account. So at least you were smart and you have this in a tax advantage account. That's great.
Yeah.
But looking at this, in my personal opinion, looking at the income statement, okay, they have positive net investment income. It looks like it's on better track than last year. I can't tell for 100% certainty because I don't have the most recent report.
Yeah, but that would be yearly once you get it.
That would be a good thing to look at. Because you can compare it year over year. You want to look at every single year and say, okay, What is their, debt to equity ratio? What is their profitability? Is it going up? Is it going down? How are they financing all their dividends? The worrying thing that was just weird to me, looking at what percentage of these distributions
are ROC.
Yeah, it's just like, oh, we want our numbers to look good. Like, oh, we pay 0.546, and we don't care what we pay out to you. It can be return to capital. It looks like they're trying to preserve the same dividend. You know what I'm saying?
Well, they've kept it for years. Why ruin the track record?
Well, yeah, it's great that they're doing that, but
but it's mostly ROC still. But again, but it's super common though. For every single CEF I've looked at, it's ROC, QILD, CLM, EIT.UN. It's all mostly like 60% plus ROC. So isn't that? It's just common. It's just I don't know if it's just CEFs in general or what. But
if it's common, it's common. But at the end of the day, they care more about just keeping their number the same than actually paying you what their profits actually are. Because like a dividend comes from your retained earnings. So what I'm seeing here is every single freaking quarter for the last 3 quarters, it's dropped and dropped and dropped. The dividend portion of it has dropped and dropped and dropped. So that means they're probably having a tough time.
And I'm assuming this, as you said, because bond prices go down, that's probably going to continue happening into the future.
Yeah, because this one is like a weird abomination because it has like stocks and it has bonds and it has swaps and all sorts of stuff going on. But you can see they had a massive loss, in this most recent annual or semi-annual report. They did. Well, they had a massive loss from unrealized losses. They did have a bottom line profit, but it was a massive difference.
Yeah,
they went from 157, million or billion, whatever it is, to 3.9.
Yeah.
So that's a very, as an investment, if you look at it, it's like that's highly volatile. Highly, highly volatile. Let's see, cash flow. Yeah, here, and they smashed together operating and investing. So they had negative cash flow from operating and investing. And then the prior report. Woo! I guess they're making a lot
significantly more.
Yeah, it's from purchase of long. So this is actually an awful report because you want to be able to separate operations from investing. Why are they smashing this together? Because you can see here, okay, it's negative, right? Yeah. Well, why it's negative? Probably because of this. That means they just bought a lot of investments. So this is a weird report. So, do you have any more questions on this? I can try to explain what's on the financials, but it's just, to me, it seems like the earnings are highly volatile. You compare just 6 months later, they go from a massive profit, bull market, whatever, to
super loss, minimum,
very narrow profit.
My only response is still better than Tattooed Chef.
I would say that's true. It is more diversified than Tattooed Chef.
Yeah, and it at least turns a profit. Well, does Tattooed Chef turn a profit?
No.
Yeah, there you go. Golf at least turns a profit. So I'm one up on Jeremy.
Yeah, you are definitely making money, but yeah, this.
Yeah,
I wish I could tell you, man. I would love to just freaking say my piece on this, but maybe I'll make a video about this. I don't know.
Oh God, if you did, I'd love that. But yeah, God, I don't know when we started. I think we spent almost an hour on just this one fund.
Yeah, we can, if we hit the other 2 companies, I can get through those because they'll actually have legit financial statements. This is a mutual fund.
Yeah,
or an ETF or whatever. It's just a lot harder to see what's going on with this thing. But I can tell you, it's insanely complex, very high expense ratio, very high distributions, mostly return of capital. The dividend part is getting lower and lower. So they're just returning more and more capital to you. to make up for the decline in dividends, because they basically didn't make a lot of money. Their profit has been hurt massively by this recent downtrend, mostly because of the options losses and because of the unrealized loss in their underlying investment. So a lot of their investments prices have gone down. So like if the stocks go up for the next couple of years, great. Their profit will look good. But if stocks go down, if you think we're going to be in a bear market, this is going to get hit pretty bad, potentially.
All right. Now, saying that, though, if it's average ROC for all CEFs, I know I've repeated myself like a broken record. It's fine because it's just industry average at that point.
Yeah, I mean, if it is the industry, I don't know what the industry average, if it is, I mean, that's not out of the normal. If it matches the average, it matches the average. You know what I'm saying?
Yeah.
If it doesn't, if it's like 120, it's 100% ROC, and the industry is like 50% dividend, 50% ROC. That's where it's like, why? That's weird.
But even, sorry, this final thing, and we can move on. But even at like that dividend channel, like dividends reinvested, you got a 307% return. That's not something to, shake your head at. That's a pretty decent return, even if most of that's ROC.
Well, ROC is not a real return. It's just, see, I don't know what this tracker's doing. If the stock chart is just taking this total distribution and saying, oh, this is profit. If the return calculator is saying this is all profit, then that's going to massively distort the actual return. Because ROC is literally them giving your basis back, your initial investment back.
Yeah.
So it could be massively distorted.
So we should go off the 9% one you saw then, because it looks like it doesn't include that, or
according to both websites, it says it has a 9% compounded annual return over that time period that we looked at. But one of my concerns is, okay, are they saying this whole distribution is part of the dividend and that's the return? Because it's not. Yeah. When you see return of capital, they're just giving you your money back.
Mm-hmm.
A dividend is coming from a company's retained earnings. It's stored profits, basically. If that makes sense.
That does. Yeah.
Cool. You want to move on to the next one?
Yeah, okay, let's leave golf behind, finally.
We started with the monster. Oh, my God.
Yeah, so I'm going to dig into that fund and annual. The next one, do you want me to send you the link here or in the...
you can drop it in here.
Okay, so this is Firm Capital Property Trust. Of course, I didn't copy the actual link. This thing sucks. It's going to make me actually look it up. So I'm going to send you the website so I don't send you a mistake again.
Oh, I will double check to make sure we...
Where is it? So they have their Q1. Do you want the Q1 or do you want annual?
I would rather see annual. I mean, we can look at both real quick, but the annuals, because like annual, you can compare year over year. Here's the 2021 annual report. Okay.
Oh, you found it already? Okay, because I was just send you that.
I'm a genius,
Man, yeah. That Kevin money's paying off, dude.
Huh?
The Kevin money is paying off.
Oh man, woo! You have no idea. Life's good. So this looks like it. Okay, it's this is a REIT, right?
This is a REIT. This is like a baby REIT in Canada that's paying, as of right now, an 8.5% yield. So another high yield stock. It's absolutely decimated as of late. So,
what's the ticker symbol?
Canada, it's FCD.UN.TO. There is an American one if that helps at all.
Yeah.
The American one is FRMUF on the over-counter market.
Over the counter?
Yeah.
No chart available. Okay.
It's been absolutely decimated as of late. The Canada chart looks a little bit different. I don't think I can actually send you. If I send you a Yahoo link, you're going to be able to see it, right?
Yeah.
Okay. So that's what it looks like on my end. If you go to Max. Yeah, there you go. That looks right.
It actually freaking pulls up.
Oh, there you go.
Okay, so it's had. Oh God, so it's had some like capital appreciation. It looks like.
Yeah, it went from $5, it got all the way up to $8, and then it just, as of April of this year, just decimated to $6.30.
Yeah, because like when it comes, I mean, like I said, when it comes to real estate investment trusts, I mean, at least in the United States, they're required to pay out a certain percent. Like they have to pay out basically all of their earnings as a dividend. That's how it works. So most of your return is going to be that dividend. But then again, you have to look at the composition of the dividend. Is it return of capital or is it an actual dividend, which we can see in a second. So I mean,
Canada, I don't believe follows that because there's a REIT, one I'm actually in, which I really like. NET/UN, it's the same thing. It only pays 50% though of its like total earnings or income. So I don't know if maybe it's just breaking the rule and paying massive taxes, but it didn't look like it was.
Yeah, that's where it gets tricky. Like I don't want to tell you the wrong thing because sometimes Canadian stuff is totally different.
Yeah.
All right, so like looking at the change in so like they've had a little bit of increase in revenue, at least year over year. So revenue's up. They had a massive increase in profits.
They went heavy into buying property. They went from retail, sold their like weaker retail property and then rebought like industrial, residential property. So that might be some of it, is them selling properties at like a massive gain to just turn around and buy more.
Yeah, because like if you look at financial statements, here's something that's going to trick people a lot. You see, okay, 12 months ended 2021 and 2020.
Mm-hmm.
So here's the net profit for 2020, 15 million or billion, whatever that is. And then you have 58 million the next year. So you don't want to be careful because in accounting, like you said, if you sell something at a gain or you have some kind of accounting adjustment that's like a non-cash gain, that'll massively distort net income. Or it can even go, it can work the opposite way. Like if you have goodwill and then you have a massive impairment charge, that can massively change net income. So I would not look at this and say, oh, it went from 15 million to 58 million. They're just going to keep growing their profits like crazy. I mean, their profit was more than their rental income.
And I'm going to send you this. You're going to love this. Speaking of ROC, once you're done.
Yeah, let me go and pull it up.
Oh, you'll love it. The title of it you'll love. 100% ROC in 2020.
We're tax efficient. It's delivered 100% return of capital. Yeah, I mean, I think it's best to just look at the profit and loss statement, because maybe there's a reason they're doing that. But if we see the income statement, you just want to see like trends year over year.
Yeah. And I just sent you the 2020 report. Yeah.
So in the report, it should have a multi-year comparison.
Okay, so you didn't even need the one I sent you.
No, it should have multiple years. Let's see. I'd be very weirded out if it didn't. That's the beauty of like financial statements. Like they'll have like 2 or 3 year comparison. Let's look at the auditor's report. Okay, so there's, in our opinion, nothing really bad. You want to skim the auditor's report just to make sure they don't do something stupid's not going on.
Oh,
okay.
Like what?
Oh, so like a company could have like terrible accountants, or because like in the auditor's report, they can tell you the auditors will tell you if they think the company's going to go bankrupt within a year. So you want to
I didn't know that.
Yeah, I mean you don't have to like read every freaking line, but when you're looking at this, you want to say it. You want to see, in our opinion, the accompanying statements present fairly in all material respect the consolidated balance sheets. That says the stuff you're looking at is accurate.
Oh yeah.
So that's just something you want to skim when you're looking at these things. Okay, balance sheet. So we can see they acquired properties. They have notes receivable. I'm trying to think if there's any massive changes. You always want to compare year over year and say, what has changed in this company? Well, we can see they bought almost $150 million of investment property. So they've really expanded their portfolio.
Yeah.
And their mortgages have gone down. Bank indebtedness has gone up. Accounts payable. This is short-term debt. Land lease liability. That's current liabilities. Total non-current liabilities. Let's see. That's interesting. So their long-term assets have increased by over 100 million. And their long-term debt has only increased by about 10 million. So the question is, how did they get these properties? They might have.
So they, I'm not sure if this helps. I had a one-on-one with the CEO in November of last year. The board members will buy X% interest in a property to help the REIT. So I don't like, sometimes like the REIT will buy like 50% and then one of the board members will pitch in and buy the other 50%. So I'm not sure if that helps at all.
That kind of sounds like a good thing to me, honestly, because they actually have some skin in the game.
Oh yeah, no, I loved it when you mentioned it, but I'm not sure if maybe that's why, you know, their liabilities only went up that much compared to, you know, their assets just skyrocketed.
Well, because we can go look at like the statement of cash flows, and that'll tell us the story. Okay, so let's look at profit. So, okay, it looks like they've increased their income from their rental properties. The interest doesn't really matter. Interest income. Let's see. No massive fluctuations. Okay, so here's what happened. Here's why there's this massive profit here. So this, you see how it's like their profit went from 15 million to 58 million?
Yeah.
That's because of this fair value adjustment in investment properties. So it looks like what they're doing in accounting is, it looks like what they're doing, we can actually look at the notes, is it looks like a lot of the properties went up in value. And they just said, oh, the properties went up in value. They're worth more. So we'll just increase we'll record that as a gain. That's what they did here. Let's go look at note 4 real quick. Fair value was determined by. Let's see. Assets held for sale. Okay. Wow, they acquired a ton of properties, it looks like.
They went all out in like 1-2 years type of thing.
Okay, yeah. So it looks like it's just a big part of this company's gains, just know this, is they're saying their properties are worth more. But you want to look at like their core rental income. If you care about the rental income, that's what you want to look at is their core rental income going up. Which, if we go back from their core business, their income before fair value adjustments. And when you look at a fair value adjustment, that just means something went up or down in price. Like that last fund that we looked at. If something goes up, you do a fair value. Yeah, you do a fair value adjustment. If something goes down, you would just adjust it to the negative. So you can see from their core business, they've actually, looks like their income is decreased by about $1 million. And a part of that is probably an increase in general and admin. There's a pretty decent increase in that, and a little bit of increase in finance costs. Their rental income has increased by 4%.
So not very much.
No. So I mean, it's their rents aren't increasing. What made this company so much more profitable is, our properties are worth more. which, great. If they sell it, of course they can make a lot of money. But if the housing market crashed,
then
this number isn't real, is what I'm saying. But yeah, so like you always want to separate the core business from the, whatever else they're doing in the business. So if you look at it from a rental perspective, their net profit from rents has gone down.
Mm-hmm.
But that was compensated by increase in property values, basically.
Which, as you said, is redundant unless you sell it.
Yes. Because in accounting, like if you're judging something based on fair value, like if you buy a stock and it goes up, whoa, it went up by 100%. I have a fair value adjustment. I made 100%, but it's not a real gain. You have to sell it to actually realize the gain. So just don't get swept up and, it went from 15 to 58. It's literally because of this. That's it. But the core business, if the rental income, the net rental income, according to the, accounting principles, has gone down.
Mm-hmm.
Which isn't the end of the world, because they're increasing their rental revenue, but that's just something to keep in mind. All right, let's see the statement of cash flows. Let's see. Okay, cash flows from operating activities. So it looks like their cash flows from operations has gone up. Yeah, so you see what I'm saying here? This massive $47 million adjustment, that wasn't a cash inflow for the company. That's why they're subtracting it out on the statement of cash flows. So their cash flows from operations went up, and that's because they had to add back, let's see, accounts payable. Let's see if there's any massive changes year over year. Yeah, a big part of the adjustments is just the change in the unrealized changes in value of these properties. Everything else looks decently similar, except for this. So they're adding back. So yeah, they're adding back accounts payable and accrued liabilities, which that's basically why there's a difference.
Yeah.
Because what happens is you have to record an expense on your income statement because you have to owe money to somebody. Like you have to pay, let's say you have to pay a vendor next month. But if you haven't actually paid the cash, you have to actually add that back on the statement of cash flows. So if you exclude this accounts payable here, I mean, they're going to have to pay most of this cash basically in the following months after this report was released. So it looks like, to me, it looks like the cash flows from operations, I mean, they're up, but they're not that different, if that makes sense.
Yeah.
All right. So cash flows used in financing activities, issuance of units, net of issuance.
Yeah, they just issued shares a few months ago as well. So yeah, they're now I know you don't like that just based off videos. However, REITs, I'm just, again, curious because a lot of REITs I've seen have issued shares for like financing property, mainly in the US because of that 90% income. Now, Firm Capital, I sent you a link to like their most recent report where they announced their payout ratio, which at least to me is super scary because now it's 109%. So they're paying 9% more than their actual profit.
Yeah, I mean, that can be sustainable in the short term, but in the long run, yeah, that kind of payout ratio ain't going to last forever.
Mm-hmm.
Let's see. So yeah, they issued a bunch of shares. Okay, I mean, if they use that to buy, because like they bought a bunch of properties, they had to get the money from somewhere.
Yeah. So at least there was some reason for it compared to like other companies that just issue shares for profit.
Yeah, I mean, this looks like a typical REIT. You know what I'm saying? Like, okay, they are profitable on their core rental business. They had a massive adjustment in their investment properties. That's great, but this is not a real sale. It's just their properties went up.
Yeah.
But I mean, let me look at the balance sheet again, see if there's any like massive warning signs. Current assets, 12 million. Current liabilities, 56 million. That's interesting. So when you current assets it's like stuff you can convert to cash to pay your short-term bills. That's going to be converted to cash within a year.
Yeah.
So you look at this, and okay, they have 12 million of current assets, but they have 56 million of current liabilities. So they're going to need to get cash from somewhere to pay these short-term bills.
But then the total assets is long-term, or it takes longer than a year to get it?
Yeah, so total assets includes short-term assets, stuff that can be converted to cash quickly. Like, for example, accounts payable. That means you're waiting to collect something from somebody that owes you money in the short term.
Yeah.
So you're going to get that money within a year. That's a current asset. Whereas your total assets, that includes all their investment properties. That's where you go up here and you say, okay, investment properties and notes receivable. So that is a little weird that they have such a low amount of current assets compared to their current liabilities. If I were to see that and have no context, that would freak me out. But that may just be normal for this business because, like, maybe they expect some kind of large influx of cash to be able to pay these short-term debts. If that makes sense. Because you look at the prior year, they had 31 million of current assets and 56 of current liabilities.
So significantly closer than what it is.
Yeah, that's a little concerning. But then again, they could just be expecting a large influx of cash. So that's just something to keep in mind. Let's see. They have positive, let's see, unit holders equity. They don't even break up the equity part. That's weird. Usually when you look at these statements, they'll show like common stock, et cetera, et cetera. Wow, that's not helpful. Overall, it doesn't seem like it's horrible. I don't see like massive. The biggest warning sign to me would be like, wow, that's not a lot of current assets compared to their short-term
current liabilities. Yeah,
that's a huge warning sign. Doesn't necessarily mean it's bad.
So, to combat that, would that be why they were like issued shares previously? Because they issued shares like legit 2 months ago and made like $20 million off of it.
It could have been. Because, like, if you don't have cash, you can't pay your short-term bills. So you got to get the cash from somewhere, and you got to, go into debt, sell a property, or issue shares.
Yeah.
So that's probably what they did to pay their short-term bills. And I'm sure they've probably had a filing where they explained why they did it.
I think they said to pay down their debt. I'm like 80% sure that's why. Sorry, okay. I'm gonna find it now. Yeah, here it is. I just found it. Yeah, here you go. It is anticipated that the net proceeds of the offering will be used to repay indebtedness and for working capital and general trust uses.
Working capital is your short-term assets and liabilities. So, obviously it's July 10th now. This was December 31st. So, obviously, business.
The Q1 report, if you want, it's more up to date, but it doesn't show, like, it's badly written, in my opinion. Again, you can be the judge of it, but
yeah, we can go look at it real quick if you want.
Yeah, it's in. I sent it in the chat.
All right, let's look at that. Maybe their balance sheet looks a lot better on here. Oh my Lord.
Yeah, there's literally nothing really here.
What's the balance sheet?
This is your Q1.
All right, this is not helpful. Yeah, this does nothing. Obviously they haven't gone out of business, and maybe this is just a normal business that has a low current ratio. That's just something I noticed. But at the end of the day, you look at it overall, I don't see any like massive warning red flags. But there's 1,000 things that can happen to a company. So this is a lot easier to look at than that freaking ETF or whatever.
Do you want to go back to it?
Oh God, do you want to?
well, I'm just like looking at the time and I'm like, oh my God, I feel so bad. I'm probably gonna keep you to go over it, but yeah, no, it's I don't know.
Whatever you want to do, man. Whatever you want to do, we'll look at.
Yeah. Well, again, I just feel
Did you have
bad.
any
Like,
specific questions? Like, did you not understand something on the income statement or the balance sheet? Like, that's something I could answer for you.
Yeah. So, like in like going back to firm capital, like that one, what was it, like the debt or whatever? Sorry, the annual report, not the Q1.
Should be this one.
Sorry, I'm gonna make you dig for that while I try to look up one final company.
All right, yeah, I'm back in the annual report.
Which one was it? So the class, which one was it? So that one where it had like the massive current assets versus current, liability.
Yeah.
So the bank indebtedness is just them taking out like a loan from a bank to pay off for property, or what exactly is that?
You have to look at the notes. So on note 6, it would tell you. Let's see. Can you see how they have those numbers next to each one of the like here? You see these numbers right here? That tells you more detail about what it is.
So you have to scroll down and manually find it. You can't just type in.
Because if I typed in note 6, this would not pop up. All right, so they entered a revolving operating credit facility with Canadian Chartered Bank, fully secured against investment properties. Let's see, line of credit. Yeah, they don't really say that much. Accounts drawn. Due to be retained so the maturity date's October 31st, 2022. And yeah. So it looks like part of that debt that they drew is due October 31st, 2022. That's why it would be really nice if they had a balance sheet, because you could literally see, okay, they have, this debt due October 31st, 2022, which is not that far away. Do they have the cash available to do it?
But obviously the Q1 report's not helpful, so we can't find that.
That's annoying. Is
that something just based on the company, like bad, showing financials for Q1?
Some companies they just give out crap. Like that's something, but it's good you asked, because you look. That's why you have to go in the notes, because the notes will say, "Hey, look, this debt is due October 31st. Do they have the cash within the next couple of months on their balance sheet to pay it? If they don't have the cash, they're going to have to either issue shares, go into debt, or sell investment properties." So then that's all it is.
Yeah. So it's nothing like, oh my God, if they can't, they don't get the cash, like I'm assuming then they'll have to sell an asset or do something, or
there's
like
what ways to raise cash. I mean, you could issue stock. Looks like people don't care. They issue stock.
It's a REIT. No one cares. Most REITs, it's like Realty Income, like one of the biggest real estate out there. They issue shares like I think once, twice a year. No one gives a shit. They'll buy.
I mean, if they're using that to buy properties, great. That's fine. But if they're issuing shares to pay for their short-term bills, that's when it's bad. But I mean, they do have positive operating cash flow. It doesn't seem to be wildly fluctuating. Their dividend, their cash distributions has increased just a little bit.
They do a dividend increase every year, because that's the thing I'm concerned about. Because in Q1 in the report, it's like we're paying out 109%, and then it's like I think last year they were paying out like 120%. So they've been paying over 100% now for 2 years.
Yeah, that's that in the long term,
like,
not sustainable.
So define long term, because for me, I'm like, oh, that's 5 years. I'm probably way off. tell me that's a stupid assumption. Please tell me. But I hear long term, like 5 to 10.
Technically, your dividend comes from your retained earnings, which, they have note 8, because they don't break up their equity here that much.
But would that be like whatever that number was, like 200 whatever million divided by like the dividends they pay, or no?
So your equity, your retained earnings increases by profits, and it decreases by dividends. And then eventually, if you run out of retained earnings, I mean, you're just basically returning capital to people.
Yeah,
that's
which is what the REIT did in 2020. It returned 100% ROC.
Yeah. But I
Is
mean,
that
there are advantages, like, okay, it's tax efficient, blah 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 blah. But I don't see any. The only, like I said, the only warning sign that I see with this is the current assets. So if you can search around current assets versus current liabilities, so if you can search around and try to find the what's going on with the most recent balance sheet. I mean, other than that, that's the most immediate thing I see. Everything else looks okay. I mean, they've increased their total assets pretty massively, and they haven't really increased their liabilities that much, which means they obviously used equity, probably financing, to acquire most of these properties. That's all that tells me right here.
okay? So it's nothing like hugely negative.
No, I would just investigate, try to find a balance sheet and see how they're looking with their current assets versus their current liabilities, and then check out that short-term debt. When is that short-term debt due? Based on this, looks like a big chunk of it is due October 31st.
Yeah.
So that's just something to consider. If they're able to meet their obligations, cool. I mean, it won't go out of business.
Cool. So I'm going to keep you for one more. If I, we can discuss if I owe you anything or anything after this, but this is the last one. This one is a very small Canadian industrial company, Decisive Dividend Corporation. Their financial seed is pretty bad. Well, it's badly put, at least how it looks compared to the other ones we've looked at.
Okay, sales up 2%, gross profit up 5%. Let's see, profit and loss. Wait, so this is for the year ended 2020. Do they have a 2021?
Oh, so I thought both. Oh shit!
Did you send me, or did I click on something?
I think I just sent you the wrong thing.
Oh, here it is.
Oh, you found it?
Yeah.
Okay, cool. I was just.
Yeah, I think it was like the first one you sent me. Okay, so let's just look at the income statement. So we see sales went up 29%. That's good. Gross profit didn't grow as fast. Gross profit margin went down. Let's see. They went from a loss to a massive profit. That's interesting. Why?
Huge amount of people requesting to buy their stuff is what the CEO emailed me when I asked them about it. This is a small industrial company here. I can literally send you their page. They're a small Kelowna-based industrial property that buys mature industrial companies and then basically uses that cash flow to sustain the dividend. So you can see a few of their stuff right there.
Okay. So they just buy companies and pay dividends. Interesting.
Literally, yeah. That's exactly what it is. Yeah.
Man, I can tell you love your dividends.
Oh, dude, you know it. I love it.
Okay, that's interesting. Yeah, so obviously, when you see sales jump like that, I mean, that's a huge increase in sales. So
I'm assuming that's something like short term. It wouldn't be consistent, obviously.
Potentially, like I would love to see like multiple years. You know what I'm saying? Because then you can really kind of get a gauge. Do they have like any other financial statements on here?
They had that one, the 2021 I sent you, which I think shows 2019.
Yeah.
In their investor, like their news section, they don't really show like anything. Okay, here you go. They literally have a financial section. Here we go. I found it. They got 2018 and 2017.
Because I'm looking at 2019 to 2020, barely any growth in sales. See, what's annoying about this is they don't have a statement of cash flows. You know what I'm saying? They don't have a balance sheet or a statement of cash flows. They're just showing the sales. So if I were to even consider investing in this company, you want to at least see all the financial statements.
Yeah, which is what they've said is they pay a dividend based on 90 to 85% of their free cash flow is their average payout.
But how do you know if you don't have their financial statements?
I emailed them, but that's the only way I know because they could obviously, BS it, and then I can't find anything on it.
So, okay, so you emailed them and they just told you that? Did they send you financial statements or they just say
that? You know what? I can literally look that up right now.
Yeah.
Dividend.
And do you know if these are audited or not?
I
Oh,
they're
no.
small. They're small enough. I want to. Sorry, they are. Or
actually, it says it is. They might have a full report on the website. Investors and governance.
I don't want to leak the guy's email, but I can send you his reply to some of the questions. I'm not sure if this will all copy over though.
No, I think I can find it actually. Hold on a second.
Oh, okay. Yeah, because if not, I sent it in the chat.
Or they have. All right.
Oh wow, no, it didn't even copy it at all. Damn.
Let me close all this crap out here. Okay. Where's their annual financials? Because they have quarter. I mean, we can look at this. Just
yeah, I think I'm pretty sure it's fourth quarter is what I think it says year end, doesn't it? For the year end December 31, 2021. So like fourth quarter report.
Perfect.
From the looks.
They've been audited by PwC. In our opinion, that's one of the big accounting firms.
Oh yeah.
No. Okay, so that's good. Trying to see if there's any crazy. No, it doesn't seem like. You want to look at going concern. What you can do quickly is like if you want to scan out a crap company, search for going concern. Because what that means is going concern just means you're assuming a business is going to last forever. And
when they say that, or
yeah, so in the auditors, when you look at a company, if you look at the auditor's report and they say there's substantial doubt about this company's ability to continue as a going concern, what that means is the auditors think the business is going to go out of business based on everything they looked at.
Okay. Is that a forward-looking statement, or is that based on just current information?
That's the most current. You definitely you want to look for that in the auditor's report. If they say there is doubt about going concern, that is massive red flag.
So is that part right there? To continue as a going concern, disclosing. No,
because this is just like generic stuff. Management is responsible for assessing the company's ability. Okay, but they don't say there's any doubt. So you're good on that front. Yeah, I don't see anything dangerous about that. Let's go look at the financials real quick. Are there actually links in this report? That would be nice.
God, I wish.
Oh, they're at the top. That's cool. Okay, so we look at current assets versus current liabilities. I don't see any major red flags there. Because you can see, look at the current assets. They have 23 million versus 11 million.
Yeah.
And a big part of their current assets is cash and accounts receivable. So even if they didn't sell any of this inventory, they would still be able to last roughly a year and some change. So they're not going out of business anytime soon, at least within a year, unless something drastic changes. Let's see. Property and equipment, really no changes. Intangible assets went down. Goodwill, looks like they had to impair a little bit of goodwill. I'm just looking to see if there's like any major like warning signs.
Yeah. You mentioned goodwill a few times in like other videos. I think it was looking at like a few Jeremy stocks. Is goodwill like a dangerous thing, or because you made it sound like it was a massive negative?
So all it means is when a business acquires another business, if they pay more for this business than the fair value, the market value of their net assets, that the plug is goodwill. Like, for example, if you went and bought Coke, if you bought all of Coke, and you went and you figured out the value of every one of Coke's factories and tractors, you probably still pay more for Coke than what those assets were worth. Because it's like a brand, if that makes sense.
Yeah.
So goodwill just means a company is paid more than the value of the company's assets minus liabilities. That's all that means.
Okay.
So, I mean, it doesn't seem like it's a massive part of the assets. What you want to be scared of is if you see like a ton of goodwill and it's like the vast majority of the company's assets. What that means is it's just like they just massively overpaid for a bunch of businesses. So, I mean, nothing crazy there. Let's see, long-term liabilities, a little bit of increase. And let's see their assets.
No, that probably like jumped hugely because they just acquired a company.
Yeah, because it looks like their long-term debt has gone up a little bit. Actually, it might net out. Hold on a second. So their long-term debt was 26 last year. 38,078. Okay, so their long-term debt really hasn't changed at all. That's nothing crazy about that. Cumulative profit, positive. Okay, so they've issued a little bit of shares.
Yeah.
They had a profit.
Mm-hmm.
Cumulative dividends. That's weird. I guess at the short. Usually, you don't see something like cumulative. Is this a Canadian? This is a Canadian company, right?
It's a Canadian industrial company. Yeah.
Yeah. Usually, like in the U.S., I don't see cumulative dividends. But whatever. There's no. I don't see any massive warning signs according to the balance sheet. But that's what you want to look at is current assets versus current liabilities. You want to see changes in long-term liabilities. They're going into debt. What are they doing it for? Are they using it to buy equipment? Are they using it to buy intangible assets? Or is it to acquire a company? So if you see goodwill go up, they must have acquired a company. If goodwill goes down, that means they've written down, they've impaired goodwill a little bit. But it's not a massive impairment.
Okay.
So I don't see anything crazy there. Let's see profits. Their sales blew up, like you said.
Yeah.
Note 16. Why? That's such a pain. That's what I hate about these reports. I wish I had like.
I'm giving you all the hard ones today, man. You had Goff, and I have this one.
Yeah, Goff was like, you can't even look at that. I mean, this isn't a hard report. It's just, let's see. Why did their sales go up?
What did their what go up?
Their sales. I'm just talking to myself. So it looks like.
Oh, yeah.
Okay. I'm trying to see which part of their business. It looks like sales on everything have gone up. That's good. I don't know if that's because of inflation, perhaps.
Look down below the year ended. Would it be U.S. maybe? Because where is it right now? The U.S. and Canada went up, and then other went up by like 3,000.
Yeah, so I mean, their sales to in every part of the world, Canada and the U.S. Obviously, most of their sales are in Canada and the United States.
Yeah,
all their sales went up. So I mean, really, their sales could be the result of they're just organically growing, or they could be temporarily benefiting from some kind of macroeconomic factor. That could be part of it. But I mean, that's positive. Like the sales are going up. The thing with investing is, do you think the sales are going to continue to go up? Now, what you can do is look at management's discussion and analysis, if they actually have that in here. All right, let's see auditor's report. This format is weird. Let's see. It's just a bunch of jibber jabber. There should be a part where the management kind of tells you what's going on.
Wouldn't that be like management comments or anything like that?
Did you see that?
No, I'm trying to look in like another financial.
Usually it's called management. There it is. Hold on. Management's discussion. Other information. Somewhere in here has got to be their management's. Usually in like the U.S. reports, there's like a link and it's towards the top.
Is management one by chance? Does it say MD and A? Because it's a separate link. It's a separate link. If you go back here, I'll send you. You're looking at the most recent one.
I'm looking at the one ended December 31st, 2021.
Okay, this is, I don't think that's it. Here, I'm sending you the link for it. Ignore that first one I sent. It's the second one. Management discussion and analysis. This is it. Yeah. For December.
Yeah, I'm just curious why the sales went up. I mean, I'm just curious, but I mean, I'm not saying that's a bad thing. Let's see. Holy, I got a lot of sales for the years increased by 29%. The increase was a result of increases across each of the manufacturing businesses. They sold more units. As underlying, Unicast, Hawk, and Northside also witnessed increased demand levels as underlying economic conditions and commodity prices improved throughout the year. So it looks like at least some of their sales came from basically inflation, but also, some of their subunits are selling. Some of their companies they own are selling more units.
Mm-hmm.
So, I mean, I don't see any like major red flags. I mean, look at the sales growth. But when it comes to like actually investing in these companies, that's where you have to say, is the sales growth going to continue? At what rate is it going to grow? That's where you kind of have to figure it out for yourself. But looking at the financials, just looking at the financials. Hold on one second.
Yeah. He's got one. It's interesting. ROC doesn't count as total return.
Oh, Lord.
Sorry, am I keeping you too late?
No, we can do like 5 minutes, then we can cut it out.
Okay.
Yeah, I'll just scan the financials real quick. Okay, yeah, something like I said, positive sales growth. I have so many freaking tabs open. Okay. Let's look at the statement of cash flow. So yeah, I don't see anything crazy with this company. Like nothing that terrifies me.
Yeah, but there's also nothing that really impresses you, or.
Well, I mean, define impress.
Like for example, like, oh, it actually looks like a solid company. Like for example, like, oh, I would invest in this, or no.
That's hard to say off the cuff because a good thing is sales are up. That's great. Why? Why are the sales up? Why is the profit up? Why? That's the real question, because accounting is looking in the past. I can look in the past right here and I can say flat. Okay, sales from 2019 to 2020 were flat.
Yeah.
Massive increase in 2021. Why? That's where you have to look. And based on that report, part of it was organic and part of it was due to commodities prices.
Mm-hmm.
So
which is not sustainable.
Maybe, right? Maybe not. That's what I'm saying. That's where I'm like, that's where I would get into the investing part, which I can't do.
Yeah.
But I can tell you, like, just from an accounting perspective, yeah, the sales are up. Looks like the profit's up.
The gross profit being slightly like 37, 38, 34. Is that a concern at all or no?
I mean, that's a little weird that the gross profit went down. Let me see if we can look.
I'm pretty sure it'd be probably like material maybe, or metal. Because didn't metal go up quite a lot in this inflation?
That could be affecting the gross profit. That probably is affecting the gross profit. Let's see. Yeah, it's probably inflation with the cost of goods sold. It's probably just a decrease in their gross profit. So, I mean, at the end of the day, like, I don't think they're going to go bankrupt just looking at the financials within a year. Their sales increased. Everything is looking positive. Their gross profit did go down a little bit.
And the fact that they acquired a company is probably going to help them like a lot this year, or
I'm not sure what they acquired.
All right.
But you see, like, they have a massive swing in bottom line profit. That's probably because of the pandemic.
Mm-hmm.
Like, see, their bottom line profit last year was negative 736. Now it's positive 2.2.
Yeah.
So there are some encouraging signs based on, the accounting part of it. But you got to ask yourself, why? Why did that go up? Is that sustainable?
Yeah.
So, but yeah, I got to head out, man. My wife's like freaking out.
Oh yeah, no. Yeah, no, go, man. I don't want to keep you. Thank you so much for doing this.
Not a problem, man. All right.
Okay. Thanks so much, man. Send me the link. Bye.
I will. Bye.